Welcome, ladies and gentlemen, from me, Guy Monson, Chief Investment Officer of Saracen Partners, to our regular weekly strategy update. I'm looking this week at the extraordinary divergence between the conditions on Wall Street, financial markets, if you like, and Main Street, the real world. On Wall Street and in financial markets, we've seen an extraordinary economic recovery. The world index up by more than 30% from its lows in dollar terms and almost break even in sterling terms. By contrast, the nightmare in the real world continues in many ways. 6.3 million infections from COVID-19 globally, more than 40 million Americans likely to claim for unemployment benefit, an 8.7% fall in the Eurozone economies projected by the ECB earlier this week, and the tragedy globally of the arrest and death of George Floyd, provoking protests in the US and around the world. So how is this divergence possible, and will it continue? I've started with a map of infection rates of COVID-19 reported in the last 7 days from the World Health Organization. The light-colored areas on the map show virtually no infections. The darker brown areas, intense new infection rates. The first observation is most of Asia is largely infection-free. Europe, infection rates dropping sharply, UK lagging. Most of the intense infection rates now coming in the Americas. And as you can see on the numbers on the right-hand side, 2.9 million, almost 50% of all infections now located, yes, in the Americas. What this shows is the progression of the disease, yes, continues around the world, but reinfection rates are encouragingly lower than we had previously expected. The second challenge that emerges is that it would seem globally that the impact of COVID-19 is unequal. It's particularly tough on the emerging world, on lower incomes, and even here in the UK, a new study on slide 3 by McKinsey shows on the left-hand side the lowest pay regions per hour in the UK, and on the right, the most intense areas of job risk post-COVID-19. Those are where there's a high risk of furlough or layoff or reductions in hours of pay due to physical distancing. And the two maps are worryingly close. This has a positive effect. It is prompting policymakers to address more aggressively that inequality, and the result is expanded fiscal and monetary programs. There also is likely to be some relief from a continuing reopening of the world economy. Now, we saw in last week's video, the global stringency index, remember, is 100 is total lockdown, 0 is the conditions pre the crisis. And you can see Germany there, the first country moving to 50. That means we're half, if you like, unlocked. And the general tempo of those market openings continues positively, particularly in Europe. Pushed by the impact that we're seeing around the world and in some of the more vulnerable areas of Europe, the extraordinary duo of Madame Lagarde at the ECB, Ursula von der Leyen at the European Commission, have extended their programs even further. Last week we saw Ursula von der Leyen's extraordinary 750 billion package of loans and grants that surprise markets. This week, Madame Lagarde has surprised markets with an even more aggressive QE program. She calls it her Pandemic Emergency Purchase Program, PEP. She said the decision to expand this even larger than people expected was unanimous. And you can see on the right, it's part of a general story of much bigger than expected central bank interventions. Dark blue, the Federal Reserve at the bottom, dark red, the ECB, then the small blue strip, the Bank of England, and then yellow, the Bank of Japan. Total central bank balance sheets now topping 20 trillion, hugely supportive for financial markets. So a combination of lower infection rates, better reopening rates, larger fiscal packages, and a huge monetary stimulus are helping to trigger a recovery. And we are now pretty certain that the low point of the world economy was late April, and May has seen some material recovery. Our two key indicators, 5-year forward inflation rates for the US expectations. Is the deflation creeping in? probably answer no. Those have ticked up a little bit further to 156. And the risk of Eurozone breakup, hugely reduced with Madame Lagarde's new QE package, that German-Italian government spread narrowing sharply. All of these could have contributed to an extraordinary rally in financial markets. On the left-hand side, you can see for a sterling investor, the pound this year to date has been weak, that we've almost reached break-even in equity returns for a globally diversified portfolio. I would add not a UK portfolio, a globally diversified portfolio, or almost back at break-even. Gold beginning to roll over a bit. We've taken some of our positions out to reflect that slightly higher confidence in the world economy. On the right-hand side, you can see the astonishing rally in sterling of the indices from their lows. And look at the leader, the S&P 500, equally weighted. That means each stock is equally weighted, not by market capitalization. In other words, those super large tech companies that had been leading are giving way to smaller, more cyclical, more economically sensitive companies. Finally, I just make one point from our own thematic perspective. What we are finding is our portfolios are coming out relatively robust from the downturn, not of course unscathed. Our digitization theme is driven hugely by the sort of changes we're seeing in operations online worldwide. Similar with the automation theme, our aging theme has tapped into a big pharmaceutical portfolio. Challenges, yes, in evolving consumption, particularly in the emerging world and travel and experiences, and a burgeoning climate portfolio, which in some cases represents almost 20% of the equities that we held. Put that all together, and I think it makes a little bit of sense of the challenges on Main Street and extraordinarily the opportunities on Wall Street. Thank you.